Okay, so I'm glad to see everyone. Today is the 27th of November, 10 a.m. Central European Time. And we are starting our webinar, which is going to be about tax planning for restructuring. And first of all, a couple of words about myself. My name is Victor Kalgin, and I am a tax partner, a managing partner at the company called Global Aim. And with our team, we help our clients to develop tax-efficient structures and to manage their tax planning matters in various countries, basically internationally around the world. And I'm happy to have on this event my co-speakers, Elia and Alex. Elia from Amicop Cyprus, and Alex from the Netherlands, from the company boutique advisory firm called InRange. Would you like to welcome the audience, Elia and Alex, and tell a few words about yourselves?
Absolutely. Thank you very much, Victor. It's a pleasure to participate in this joint event together, and I hope we can add value to the participants today. As you rightly said, my name is Elia Nicolaou, and I'm the Managing Director of Amicop in Cyprus. Globally, out of our 45 offices, we offer solutions for implementation purposes of what you guys advise your clients to actually structure their business. So we can assist with anything in relation to the implementation procedures being applied.
Great, thank you, Elia.
Hey everyone, my name is Alex. I'm founder of a company called InRange, based in Amsterdam. For the last 15 years, I've been helping clients with transfer pricing matters across Europe. So I'm very happy to be here. Hope you like the webinar.
Very good. Very good. Thank you, Alex. And without further ado, I suggest that we start, and we have 2 hours ahead of us and very dense, I would say, agenda. So in a few seconds, we will continue from the very first parts and from the agenda itself. So stay with us. We'll get back in a few minutes on the tax planning of restructuring from structuring to implementation. Stay. So we are now starting our webinar, and we are going to discuss tax planning for restructuring and review practical cases and see how restructuring projects can be done, first of all, and primarily from tax planning perspective, but we'll also have practical examples and other speakers who will join me later, and we will address non-tax implications and implementation techniques of restructuring projects. But first of all, let's talk about the agenda, and we'll have four parts in this webinar. In the first part, we'll review the key tax fundamentals of restructuring planning of restructuring projects, and we'll review 4 main tax objectives, namely minimal tax leakages. The restructuring project should be planned in a way that no taxes are lost. Ideally, no taxes are paid at all during changes of a business structure, but at least minimal tax burden is one of the key objectives of tax planning for restructuring projects. Next, in this part, we will look at how to preserve tax efficiency of the structure in course of restructuring projects. A more difficult task, the third objective, is to enhance and to improve the tax efficiency of a particular structure. And finally, the fourth objective is sometimes possible to create tax assets and to improve tax attributes of a particular structure, and we'll talk about it in the first part. Next part will be about practical aspects of restructuring, and I will give the floor to other speakers, Elia and Alex, and they will talk about structuring of building and changing structures in Cyprus, as well as transfer pricing perspective of restructuring projects and making it right from transfer pricing perspective in the context of the recent European practice and case law. The third part will be will be mainly a case study of a practical case where we will together develop a target structure based on tax model and see how it can be, how different options can be compared, and all brought to the final number, the final factor being the tax efficiency of the target structure. And this is the tool that we use in our consulting projects, where we compare different options and choose the one that is not only tax efficient but also practical and is aligned with business needs. So this is going to be a case study in this third part, and we will briefly talk about planning and implementation stages of restructuring projects. And finally, we'll have the closing parts with questions and answers. And we received numerous questions before the webinar. And as I said, please do not hesitate to ask your questions in the chat section. And we will have time to answer those questions at the end of the webinar in the fourth part. Okay, before we begin and discuss the four key objectives of restructuring projects, let's review a practical case, which is based on several practical examples, which I aggregated in a simple task in a restructuring project, or a restructuring task where it is necessary to change a structure before a joint venture, or it could be in an IPO context, but in this case, we're going to be talking about a case where a joint venture is set up. And as is shown on the slides, there is a simple structure with a holding company in a, well, so far, let's not talk about specific countries and jurisdictions. Obviously, restructuring projects are very country specific, but in general, the task itself is about the current structure and its transformation in order to set up a joint venture. And the current structure is where a holding company owns a number of subsidiaries, and these subsidiaries are the assets that are going to be contributed to a joint venture, and their attributes are as follows. There is acquisition costs. The total acquisition cost of these subsidiaries is $40 million. Then their fair market value is much higher. It's $100 million, which means that the assets significantly appreciated in their value. And the holding period, the time that the holding company owns these subsidiaries, is more than 1 year. Other important data is that the joint venture share is going to be sold to the joint venture partner. So it's kind of a cash out exercise where these subsidiaries, after being contributed to a joint venture, then the joint venture share of 50% is going to be sold to the joint venture partner. And in the country where the holding company is located, the holding period requirements for participation exemption, after which assets or subsidiaries shares can be sold without taxation of capital gains, is at least 1 year. So after 1 year holding period, which is in our situation is fulfilled, this condition is met. So if the subsidiaries were sold directly, then there will be no tax leakage and no taxation of capital gains. But in our situation, first of all, the attributes need to be contributed to a joint venture. This is a new company, and let's assume in this for this case that the contribution was based on valuation, on cost-based valuation of the historical cost of $40 million. And yeah, the subsidiaries were contributed to the joint venture, to the new company, at a cost of $40 million. After the contribution, as is shown on this slide, the subsidiaries are now owned by the joint venture, and the joint venture is 100% subsidiary of the holding company. And then the joint venture partner appears and acquires 50% share of the joint venture of the JV company. In which case, as we all remember, the contribution was made at a cost, and this cost was carried to the joint venture shares. And since only half of the shares are sold, then Okay, the valuation is 100 million. The cost basis of the joint venture as well as the subsidiaries is 40 million. The difference is 60 million, and 50% of the 60 million is $30 million, which is the taxable base, the tax base for the holding company on the sale of 50% shares. It is important that the participation exemption does not apply, because after the contribution, the shares in the joint venture were sold within less than a year. This is why the participation exemption does not apply, and the capital gains are subject to tax. And here questions arise, obviously, in terms of tax planning. What was done correctly in this restructuring? What could be improved? And what are the restructuring options? The options to set up the joint venture can be considered. So these are the questions. Let's see how. And we are going to get back to this example and see how these questions can be answered at the end of the first part, after we have reviewed and addressed the 4 key objectives of restructuring and how they can be met in specific circumstances. Okay, the first part, we are now in the beginning of the first and the most important part of this webinar, which is about the tax objectives of restructuring projects. There are 4 key tax objectives. At least we at Global Aim, we tend to look at 4 objectives that we do our best to help our clients to meet in course of restructuring, tax planning of restructuring project. First of all, the restructuring itself should not lead to excessive tax burden, and the tax leakages during the restructuring should be kept at a minimum. This is the first objective. Second, the tax assets and the tax efficiency of the structure, the new structure, should be preserved. It should not be worse than the tax efficiency of the initial structure. And yes, in the structure, there are tax assets that need to be carried forward, and we'll talk about this, the sorts of assets that need to be taken care of when we talk about this second objective. The third objective is the enhancement of the tax efficiency of the target structure. Whether it can be improved, whether the change itself can lead to a new and more tax efficient structure. And finally, sometimes it is possible to create tax assets in course of restructuring project. So objective 1, minimal tax leakages during the restructuring. And let's look at a practical example where we have a holding company in Cyprus with its subsidiaries, and the objective is to move to the United Arab Emirates. The subsidiaries remain in place; they are all over the world, but the holding company needs to be moved to the United Arab Emirates, and this is the purpose. This is the goal of the restructuring. What can be done? And let's consider a specific steps in order to achieve the target structure. First of all, the shareholder can establish a new company, which is going to be in the United Arab Emirates as planned. Then the current separate holding company can sell its subsidiaries to the new holding company, after which we have the new structure basically in place, but the old holding company in Cyprus needs to be liquidated. And yeah, it distributes liquidation proceeds to the shareholder. And so, yeah, finally, we have the target structure where the subsidiaries are owned by the holding company, which belongs to the shareholder. Let's look at the different levels of the structure and see where tax leakages can occur. First of all, from bottom up, the subsidiaries, there may be tax implications at the level of the subsidiaries. For example, holding companies that own real estate, when they are sold, it is not uncommon for the countries where such companies are located to tax capital gains on the sale of profits reach of real estate companies. Second, it is not uncommon for subsoil user companies that extract minerals in a specific country to consider such capital gains to be subject to tax in the country, again, where the minerals, the licenses are located. And finally, sometimes any companies, any capital gains on sale of local companies are subject in the country where the company is registered, unless treaty protection applies. So this is the bottom level, and this can be illustrated based on specific provisions. So, for example, the Russian tax codes, and we work a lot with restructuring of Russian assets. And here we can see the corresponding article of the Russian tax codes, which basically says that income received by foreign companies, which is not connected with its permanent establishments, should be considered Russian-sourced income and subject to taxation. And the list of income goes on, and one of the items on the list is income from the disposal of shares in companies that own more than 50%, which assets consist of real estate by more than 50%, by Russian real estate, obviously. So this is the situation where taxation occurs in Russia. The situation is property-rich companies that are sold by their direct or indirect non-Russian shareholders. It's important to note that there should be income, first of all, and there should be disposal. Disposal meaning change of ownership from the old holding company to the new holding company. If both conditions take place or occur, then the sale is considered to be Russian sourced and subject to taxation in Russia. In Kazakhstan, there is a similar and even broader provision that basically says that capital gains from disposal of any shares of companies in Kazakhstan is subject to taxation. It's considered sourced in Kazakhstan. And also if 50% or more of the value of even foreign company consists of a property in Kazakhstan, it's also considered Kazakhstan-sourced income. So as you can see here, the provision is even broader, and simple, straightforward, non-property rich, non-subsoil user companies are considered, when they are disposed of, their capital gains from disposal is considered to be taxable in Kazakhstan. So it's not uncommon. Okay, moving up. And the next level is the level of the holding company. Here, taxation can also apply. Tax implications can occur in connection with profits or capital gains from the sale. Sometimes exit tax rules apply, and there may be withholding tax implications on the distribution of profits, either actual profits or deemed profits if the transaction is not arm's length. Okay, so it's not surprising that the holding company that receives income or capital gains in course of restructuring can also subject to taxation in the country where it is located. We'll get back to this example later, but let's look at the top level, at the shareholders level, where CFC rules can kick in. CFC meaning control foreign companies, and even if profits at the holding company's level are not subject to taxation, as is the case in Cyprus, then nevertheless, these profits can be caught and subject to personal income tax at the level of the shareholder. If the shareholder is a tax resident in the country where CFC rules apply, and there is no exemption for such particular cases where subsidiaries controlled by the individual who is a tax resident, for example, in Russia or Kazakhstan, such subsidiaries receive passive income, such as capital gains from sale of shares. In this case, CFC rules kick in, and these profits, even without being distributed at the level of the shareholder, is considered to be subject to tax in the country where the shareholder is a tax resident. Okay, CFC rules, and at the shareholder level, if something is distributed to the shareholder, which may be the case when the old holding company is liquidated, then this distribution is can also be subject to taxation. And let's look at the liquidation of the holding company and how this the old holding company, how this how this can lead to taxation at the level of the shareholder. After the holding company sold its subsidiaries to the new holding company, the holding company in the United Arab Emirates, then it's no longer necessary to keep this company in place, but it still have a receivable to the new holding company because the subsidiaries are valuable. The transaction, given its arm's length, is at a high cost, at a high value, and this receivable can worth significant amounts, and if without paying it, the holding company is liquidated, then this receivable is distributed to the shareholder. If it's paid, then the consideration is the asset that is distributed upon liquidation, which is why basically we have two options here. Let's imagine that the shareholder is in the country where CFC rules apply, for example, Kazakhstan or Uzbekistan or another country with CFC rules. Then there are two options: either to distribute assets of the holding company and liquidate it to make sure that no CFC consequences arise, or wait and keep the receivable at the holding company's level, in which case the tax base will arise anyway at the level of the shareholder, but due to a different mechanism, CFC rules will apply in this case to undistributed profits of the holding company, which is not liquidated, which is unfortunate. And this means that the restructuring which we've just reviewed, the restructuring process that we looked at, is unlikely to be tax efficient. If, for example, the subsidiaries are property rich or are subsoil users, then the sale is likely to be subject to tax in countries which tax such capital gains, which is the case in Russia, in Kazakhstan. Next, at the holding company level, tax leakages are to the contrary unlikely, because if the structure is properly set up and Cyprus is a good holding jurisdiction, then capital gains are not likely to be subject to taxation. It can be either unconditional exemption, or participation exemption can require certain holding periods or share, or taxation at the level of the subsidiaries, certain tax rates, or there may be a combination of the conditions. But at the end of the day, if the structure is set up properly, then restructuring can be done in a tax efficient manner. Okay, and at the level of the shareholder, either CFC rules apply or liquidation proceeds is subject to personal income tax, in which case the shareholder can either change his or her tax residency, or there is an option to redomicile a company, and this makes a huge difference in some cases, because redomiciliation is change of the company's registration from one country to another. So it's moving of the company from one place, from one jurisdiction to another, without changing its legal identity. In which case, we do not have sale as such. There is no income from sale. The company just changes its legal address, and at the same time, the company doesn't receive any capital gains, which means that at the level of the subsidiaries, the tax implications are not likely to arise, because there is no income, there is no capital gains. The company basically remains intact, but just changes its address. And at the level of the shareholder, CFC rules are not likely to apply, because there is no transaction, no profits, no capital gains, which is a good solution. Still, it doesn't come without its disadvantages, but the advantages, as I discussed, doesn't constitute a taxable event. Redomiciliation is not a taxable event usually, which means for CFC purposes, for the subsidiaries, it's not likely to lead to tax implications. Again, It can vary depending on a specific jurisdiction, which is why attention to local rules is important. But as a primary, as a main hypothesis, it's a good start to assume and then to check whether indeed it's not considered a taxable event at the level of the subsidiaries and for CFC purposes of the shareholder. And also the original holding company, which can have some useful attributes, can be subject to, can have certain claims, different assets. There can be different partners with partnership agreements between them. So the company with its history is maintained and it retains in the structure, but just changes its country of registration. It doesn't come without disadvantages. It comes at a cost. Redomiciliation can still trigger exit taxation in the holding company jurisdiction. It usually takes more time. That's a second disadvantage, and it's a more complex process than the sale of holdco assets, and it's not always possible. Not all countries allow redomiciling companies from their jurisdiction, and not all jurisdictions accept redomiciliation from other countries. So it needs to be checked whether both countries where we redomicile the company and from which we redomicile the company allow this process of redomiciliation of legal entities. But if it works, it can be a good solution. So 3 conclusions here. We've just discussed the first objective of the structuring of tax planning of restructuring projects, and it's to minimize tax leakages. And this is important. It's rarely expected that a restructuring itself, without increase of business or sale of assets to a third party, leads to significant tax costs. It's difficult to accept this. And this is why tax planning of restructuring usually assumes that something can be done to avoid excessive tax costs and maybe to avoid tax leakages altogether. Taxes can arise at different levels, at the level of the operating subsidiaries, at the holding and intermediate holding companies level, and ultimately at the shareholders level. And it's useful to consider several options as we looked at in the practical example, to see which is the most efficient one and which leads to least tax implications in course of the restructuring. Second objective is to preserve the tax efficiency and useful tax attributes in the structure. This is one of the important objectives of the restructuring, and what issues can arise when we change the structure and what possible solution exists. We'll look at a specific example, which is a court case where the tax authorities challenged the tax consequences after the restructuring was done. So it's a Russian case where the structure was relatively straightforward. 3 companies consequentially owned each other. There is a ultimate parent company, there is the intermediate holding company, and there is the operating subsidiary at the bottom. And this structure was in place as of 2015. And then the idea was to simplify it and to move the subsidiary one level up, so that the group parent company owns it directly. And for this purpose, the intermediate holding company was subject to reorganization, so that a spin-off took place, and the project company was spun off from the old intermediary holding company, and it took the subsidiary with it upon the reorganization. In which situation, basically, it was carved out from the subsidiary was carved out from the total assets, other assets of the intermediate holding company, and it was moved to the newly established or newly organized project company, which was immediately merged into the parent holding company. After which the subsidiary became directly owned by the group parent company, because the project company, which was spun off from the intermediary holding entity was immediately merged into the parent holding company with its subsidiary, which was carved out with it when it was reorganized and initially formed. Okay, so at the beginning of 2016, shortly after the restructuring started, this structure was established, and then in August 2016, and we'll remember that the restructuring took place at the end of 2015. Less than a year before August 2016, the subsidiary distributed dividends to the group parent company. And here it's important to know that participation exemption only apply in Russia after 1 year holding period ends. So the subjects, one of the most important conditions for the participation exemption, for the exemption of dividends that Russian companies receive from their subsidiaries, is that the subsidiaries are owned by the respective parent company for at least 1 year. Otherwise, the exemption, the zero tax rate, does not apply. And since less than a year passed between the restructuring and the distribution of dividends, November 2015 to August 2016, the tax authority decided that the participation exemption does not apply, and that's it. They basically charged the subsidiary or the parent company with additional tax of 13%, which applies to dividends income if participation exemption in Russia does not apply. Okay, so the parent company challenged this decision, the tax authority's decision in court, and the courts took sides and agreed with the company that although less than a year passed after their reorganization, still the organization does not interrupt the holding periods for tax purposes, and since the initial structure was set up in 2010, then the exemption should apply to the newly emerged post-restructuring setup. So this is good news that the decision was positive, but it illustrates a very important concept, that during the restructuring, different tax attributes in the structure can change, and in this particular situation, the holding period started, at least in the view of the tax authorities, started to run from zero, basically. And the holding period, since it was interrupted, required more time before dividends could be distributed with the exemption, with the participation exemption to apply to the dividends income. And despite the tax authorities lost in court, the problem exists, and from the very beginning, different strategies could be considered to avoid the claim, the tax claim from the very beginning. Of course, it's always positive to defend your position in court, but if you can avoid it, you can avoid the confrontation and the challenge from the tax authorities, it's even better. What could be done? First of all, the dividends could have been distributed before the restructuring took place, and yeah, the structure was in place for a long time. 1 year holding periods definitely was over before the restructuring, which is why, of course, it took 2 steps to distribute dividends from the subsidiary to the intermediary holding company and then to the parent company. There could have been difficulties. For example, the intermediary parent company could have had losses, in which case some or even all dividends could have been trapped in between, and that's why it may not have been possible. But as an option, before the restructuring, dividend distribution before the restructuring could be a solution to avoid tax claim in the first instance. Second solution is to distribute dividends after 1 year holding periods is over, which is possible again just a few months before November 2016, when 1 year holding periods should have elapsed after the restructuring took place in November 2015. 2015. And the order of their reorganization could have been different. And it is possible to, first of all, to maintain basically the ownership of the intermediary holding company in the subsidiary so that it is not interrupted. It would have required a different set of transactions and maybe a more complicated one. Basically, what we needed is to carve out all the old assets and to for the project company to spin off owning all the other assets, while the intermediary holding company should have retained its ownership in the subsidiary, and then the ultimate parent company could have merged into the intermediary holding company. In which case, the results would have been the same, but the subsidiary would have been owned by the intermediary company, which is now merged with the parent company without interruption. A more difficult solution, but let's keep in mind that it exists. Okay, so other not only the tax efficiency of the target structure should be preserved, but also the tax attributes of different parts of the structure should be maintained to the extent possible. So the examples include cost basis of assets in the structure. If it's lost, then although the tax efficiency of the structure may be okay, but if we dispose of assets which cost basis is lost after the restructuring, then the capital gain taxation is much higher, which is not efficient. This is why we should carefully preserve and maintain the tax attributes and acquisition costs or cost basis of the assets in the structure, and also tax losses. And in legal reorganization, it's usually possible to maintain tax losses and cost basis of assets, but it's not the case in case of sale of companies and redomiciliation. At least one should be careful to assume that upon redomiciliation, for example, the historical losses can be carried forward by the new company. It's usually for tax purposes after the company redomiciled into the new country. It's not uncommon to start all over again without historical losses being transferred and carried over to the new company. Okay. So it depends. Sale of companies can also help to preserve some attributes such as cost basis, but losses in this case can be lost as well. So losses can also expire in case of change of ownership, at least in some countries. If the ownership of the company is changed, this can trigger expiration of losses that the company has had accumulated. Okay, is it possible to improve the tax efficiency of a structure during restructuring? And this is the third objective. It is sometimes possible, indeed. And let's look at a particular specific example. Again, this is in the context of this is a case law again, and we have an example where there was a subsidiary in Kazakhstan, and its holding company, which was initially established in the BVI in the British Virgin Islands, and then at some point in time, it became a tax resident in Russia. So although the company was registered and continued to be registered in one of the offshore jurisdictions, BVI, it became a Russian tax resident. It is possible. It is possible for the company to be registered in one country, but to be a taxpayer or tax resident in another country. And this is the case. The company became a tax resident in Russia, and it distributes the subsidiary in Kazakhstan distributes its dividends over the years 2018, 2020, distributed dividends and applied withholding tax rates of 10%, which is available under the tax treaty between Russia and Kazakhstan. The domestic rate for dividends in Kazakhstan is 15%. Moreover, when income is paid, including dividends, to a so-called low tax jurisdiction, which includes BVI, then the rate is increased to 20%. But the treaty between Russia and Kazakhstan allowed to use a reduced withholding tax rate of 10% to dividends. So despite the company claims the reduced tax rates, or because it did, the tax authorities challenged the withholding tax incentive or withholding tax benefit in the structure and charged withholding tax at a rate of 20%, exactly because the BVI is a low tax jurisdiction, or so-called jurisdiction with a preferential taxation, and the rate should be 20% instead of 10%. And one of the arguments that the tax authorities used was that in Russia an exemption applied to dividends received from the subsidiary. Okay, so the dispute was taken into court, and the court's position was positive in favor of the taxpayer of the company, because despite the holding company was registered in BVI, tax treaties apply based on tax residency status, which was Russia, and the exemption of dividends does not prevent the application of the reduced rates under the Russia-Kazakhstan tax treaty. So the decision was positive, and the company managed to defend its tax treaty benefits and the reduced rate of 10%. Okay, so three conclusions here after having looked at this example, which illustrates how structure can be improved in course of the restructuring. We see here that the initial structure where the parent company was registered and tax resident in BVI triggered withholding tax of 20% upon dividends distribution, but the tax efficiency improved after the company changed its tax residency to Russia, and it didn't even require to transfer assets. The tax efficiency of the structure, the result, the conclusion here is that the tax efficiency of the structure can be enhanced and improved without transferring assets and even a redomiciliation of the company. The tax residency can be changed, and thus this gives access to new tax benefits depending on the location of tax residency of the company. Important outcome here is that tax treaty benefits apply based on the tax residency, not on the company's registration, although it is not uncommon for the tax authorities to dispute, to challenge this conclusion. And the exemption of income, in this case at the holding company's level in Russia, does not prevent from application of tax treaty benefits. At least it was possible to defend the reduced rate in Kazakhstan despite the dividends exempt at the holding company's level. Okay, very interesting. And let's move on. And the final and fourth objective is to create tax assets upon the restructuring. It's even more difficult. And this there is another case here, again in the Russian context, where it is fully illustrated that it is not easy to create tax assets and additional tax attributes when in course of the restructuring. This is a real case which illustrates a debt pushdown, so-called debt pushdown concept. And we see here a structure in a simplified manner where there is a ultimate parent company in the United States which indirectly owns one Russian subsidiary, and then there was another Russian subsidiary owned through a holding company in the United Kingdom. And in 2011, there was a global merger between two large multinational companies, and this is the result of the merger. This is why two parts of the structure combines, and from different parts, different companies merged into the same structures. This is why we have here two Russian companies. And the idea was simple: is to simplify the structure. And what was done was that the UK holding company sold its Russian subsidiary to another Russian subsidiary, and then this debt for the sale was converted into credit note, and for some time interest accumulated on this credit note, basically loan. At some stage in 2014, the Russian companies, and you remember that one of the Russian companies acquired the other one, so the one Russian company became a subsidiary of another Russian company, and they merged to form one single entity. And then the single entity repaid its debts to the UK holding company, which was the seller of one of the Russian subsidiaries before the restructuring took place. So what it meant was that when the debt is paid, and moreover, some interest was accumulated and interest was deducted and paid as well, there was no withholding tax on the repayment of debt, and even more, interest which was not in the structure before the restructuring took place started to be deductible at the level of the surviving post-merger subsidiary in Russia. And this basically illustrates the so-called debt pushdown concept, where not only some profits could be repaid as payments for the acquisition of a subsidiary without withholding tax, but also interest can be accumulated and deducted and then paid without withholding tax from Russia to another country. So that which was not in the structure before the restructuring occurred in the post-restructuring setup. And this is important attributes and improvements of the efficiency of the structure, and even resulted in some additional tax benefits, such as deduction of interest in the post-restructuring setup. The Russian tax authorities reclassified the payments of credit notes and interest as dividends, and claimed that the UK holding company was a technical company which distributed dividends immediately after it received the repayments of income for the sale of one of the Russian subsidiaries. The restructuring itself had no business purpose, and the accumulated profits were used to repay the loan and were not taxed abroad at the level of the holding companies and up the chain. And the tax authorities agreed. The tax authorities, first of all, they challenged the deduction of their interest and charged 5% withholding tax on loan repayments, as if it was dividends paid to the ultimate parent company, ultimate parent entity in the United States. And the tax authorities managed to defend this position in the court's dispute, and the judges took sides of the tax authorities and agreed that the restructuring should not have led to interest deductibility, interest deduction, and the repayments of the loan is economically dividends and should be subject to withholding tax at a rate of 5%. Okay, 3 conclusions here. First of all, case law on debt pushdown is generally negative. It's developing negatively, not only in Russia, but in other countries. There may be different situations. For example, M&A transactions where leverage buyouts can take place, and it's not always that interest expenses are deducted, which may make a difference in terms of tax consequences, as well as the inclination of the tax authorities to challenge the restructuring consequences. What could be done here? One can consider, instead of repaying the loan and avoiding withholding tax in one go, is to try to refinance the one of the subsidiaries that's acquired by another company, and to gradually move the loan or the debt at the level of the operating company, instead of merging the companies and repaying the loan in one go. So it may be more time consuming, and it will not lead to the same and immediate tax benefits, but it can be more sustainable if the changes are not, if the changes are more gradual and occur over time. Okay, before we conclude this first part, let's return to the example we started with. And let me remind you that we looked at a joint venture structure where subsidiaries were contributed at historical cost to the joint venture, and then the joint venture share in the joint venture was sold to the JV partner at the market price, and the cost base upon the sale was $30 million because historical cost was 40. The market value of the total value of the subsidiaries is $1 million, and the difference is 60 million, and half of it, 50%, which was sold to the joint venture partner, is 30 million. Depending on the tax rates in the holdco's jurisdiction, the tax leakage can be quite significant. But the good news here is that there is an actual transaction, actual sale of assets, but still, what can be done differently? What could be done differently? First of all, the cost basis of the transferred subsidiaries could have been maintained. It's not always possible. It will depend on the jurisdiction. But if the valuation was not based on the cost, but instead the valuation was at market level, then it was possible to value the assets at 100 million, in which case, of course, capital gains could have arisen in the holding company's books. But we all remember that the subsidiaries were owned by the holding company for more than a year, in which case capital gains should be exempt. Okay. So instead of valuing the subsidiaries at the historical cost, valuing them at the market value would have resulted in a higher valuation of the joint venture shares, in which case no capital gains or much smaller capital gains would have arisen on the sale of the 50% share in the joint venture. Okay. This is what could be improved, but obviously, at least the cost basis was maintained, and this is one of the objectives of the restructuring. But again, the improvement could be made, and I already discussed that the valuation could be market-based, 100 million instead of 40 million. Instead of the contribution, other restructuring options include sale of subsidiaries to the joint venture. Again, we'll remember that capital gains from the sale of subsidiaries, given the holding periods, should be exempt, in which case the sale, again, at the market level would have resulted in a receivable of, let's say, $100 million. And then the joint venture, both the receivable and the share in the joint venture could have been sold. And again, the outcome would have been that no capital gains is taxed. And another option, if it's not possible to sell the subsidiaries there this is the slide where we look at capital gains and their tax exemption. The receivable can be transferred, but instead, the other option would be to contribute the assets to the 50% share of the joint venture, so that the remaining share could be kept by another entity in the holding company's group. And in this case, only half of the joint venture would receive the historical cost basis. And that could have been the case in Russia, for example, where it is not possible to step up in cost, to achieve the step up in cost basis upon contribution into capital, in which case, again, we maintain historical costs, but only allocated to the 50% share of the joint venture, which is then sold, in which case capital gains is much smaller. If we contribute all the assets with historical costs of 40 million, and then sell it for 50 million, then the difference in tax base is only 10 million, which is much better than the 30 million in the initial example. Okay, so there are options to consider in addition to what we looked at in the beginning, where the tax base was $30 million. And the bottom line here is that different options should be considered. And there are solutions to either to fully mitigate taxation in course of restructuring, or to significantly reduce the tax leakage. Okay, this is it. The first part is over, and now let's look at practical aspects of restructuring, and Elia and Alex will explain and share their experience, and I should give the floor now to Elia. Thank you, and I'll see you again in the third part and in the Q&A section. Stay tuned. Elia will join soon.
Good morning, ladies and gentlemen, and thank you for joining us today. My name is Elia Nicolaou, and I am the Managing Director of Amicorp in Cyprus. Today, I'll guide you through the practical aspects of structuring and restructuring Cyprus companies, including holding and headquartering structures, trading, IP, and fund structures, as well as redomiciliation and liquidation procedures. This session aims to provide you with a practical and commercially focused understanding of how Cyprus structures can be implemented effectively and in full compliance with the local and EU regulations. Cyprus has traditionally acted as a business hub and played a pivotal role in the business world. It provides unique and highly competitive advantages for the most efficient conduct of business. Its location at the crossroads of Europe, Asia, Middle East, and Africa, as well as its European Union and Eurozone membership, position it strategically as a bridge between various key jurisdictions. Cyprus offers a fully transparent and EU OECD compliant tax regime, supported by more than 60 double tax treaties. It also provides a low-cost, pro-business environment, access to skilled workforce, and high-quality professional services. Importantly, Cyprus operates a common law legal system based on English law and offers a high standard of living, all of the above compiling a competitive and credible international business jurisdiction. Here are some of the tax fundamentals for Cyprus. It offers one of the most competitive corporate tax frameworks in the EU, with a standard rate of 12.5%. Through the national interest deduction mechanism, this can effectively be reduced to as low as 2.5%. Several income streams benefit from full or partial tax exemptions, including dividend income, interest income, and gains from the disposal of securities. Additionally, there is no withholding tax on dividends, interest, or royalties paid to non-resident shareholders. There is also no capital gains tax except on the sale of immovable property located in Cyprus. Cyprus also maintains an extensive network of double tax treaties. As an EU member state, Cyprus benefits from the EU Parent Subsidiary Directive, which allows tax-efficient repatriation of profits between group companies within the EU, provided the relevant substance and residency criteria are met. Low corporate income tax levels and the absence of capital gains tax make Cyprus attractive for holding and IP-driven setups. The incorporation process is time-efficient and straightforward. After KYC and AML checks have been fully satisfied, we proceed with name approval and the filing of incorporation documents with the Registrar of Companies. This process takes approximately 7 to 10 days to be completed. Post-incorporation, companies must maintain accounting records, conduct audits under IFRS, file annual and tax returns, update UBO register, and maintain substance in accordance to their activities. Having looked at the incorporation process, let us focus on some examples of the most commonly used structures. In the first example, a Cyprus holding company is used to hold all underlying subsidiaries based in EU and other jurisdictions on behalf of a Kazakhstan owning company. There is no corporate income tax on dividends received at the Cyprus level and no withholding tax on outbound dividends or inbound dividends from active subsidiaries. The dividends received in Kazakhstan are exempt from corporate income tax and CFC rules arising can be managed. Funds can either remain within the Cyprus company and be reinvested or distributed further to the shareholder. This type of structure is suitable for companies looking to expand beyond their local jurisdictional boundaries and choosing a tax-effective headquartering jurisdiction to set up and establish presence through proper management and control. Moving on to our second case study, picturing a typical trading structure for an Uzbekistan manufacturer. All transactions are done at arm's length. Corporate income tax will be at the level of 15% in Uzbekistan and as low as 2.5% in Cyprus. There will be zero export VAT rate in Uzbekistan, and the Cyprus company which will be registered for VAT will be exempt from VAT when transacting with other VAT-registered EU companies. CFC rules in Uzbekistan will not be triggered since the Cyprus company will be an active one. This structure enables trading within an EU counterparty, which may give more comfort to the buyer, address VAT-related recharges, and provides for low taxation of revenues at the Cyprus level. Our third case demonstrates a typical IP structure. Cyprus's IP box regime is amongst the strongest in the EU. Qualifying IPs consist of patents and copyrighted software. Effective tax on license fees received can reach as low as 2.1% when combining the IP regime and the NID. Dividends can be distributed to the UAE owning company without any withholding tax. On the potential sale of the shares of the IP company, no capital gains will arise. This structure is ideal for technology, R&D-driven groups and startups seeking substance and EU credibility. Moving on to our next slide. The use of collective investment funds has been receiving increased attention in the last few years. Cyprus funds provide flexibility with full EU regulatory oversight, giving comfort to investors and regulators. Funds, in the same way as companies, enjoy exemption from corporate income tax on dividends and capital gains, enabling efficient pooling of different categories of assets. In the same way, there is no withholding tax upon distribution of dividends. We can see that a single fund can operate different strategies, either via different compartments or under SPVs, thus achieving segregation of assets. If the fund is in the form of a limited partnership, then the structure is tax transparent and distributions are taxed at the level of the recipient investor. Funds would not qualify as CFCs, but does not be subject to CFC rules which would otherwise be applicable in the case of Kazakhstan or Uzbekistan companies. Requirements under GAR and POEM are also addressed since the appointment of an IFM, fund administrator and depository substantiate management and control tests. Having looked at how we can utilize Cyprus structures, we can now consider the option of redomiciling the same out of Cyprus. Of course, a redomiciliation into Cyprus is also possible, but will not be addressed during this seminar. From our experience, the most common jurisdictions in which we have seen domiciliations taking place are the UAE, Mauritius, and Russia. The process includes a shareholder resolution, interim statements, newspaper publications, and regulatory clearances to be filed with the Registrar of Companies. After a 3-month objection period, the registrar issues consent allowing the company to continue its business abroad. This consent is then filed with the foreign authorities, and once the certificate of continuation is issued, the same is filed with the Registrar of Companies for final deregistration of the company from the registry. This process may take approximately 6 months to be completed, depending on the foreign jurisdiction's efficiency. Our final reference is to members' voluntary liquidation in relation to solvent entities. Key stages include finalization of accounting and audit records, appointment of a liquidator, issuing of clearances from the tax authorities, VAT, and social insurance authorities, followed by solvency declaration, meeting of the shareholders, and publication in local newspaper follows. Once the liquidator assumes control of the operations and assets, proceeds to the realization and distribution to shareholders. The last stage involves the preparation of final accounts and final general meeting. The whole liquidation process may take from 6 to 12 months to be completed, depending on the issuance of these clearances and distribution of assets. Finally, let me mention that at Amicro Group, we can undertake the implementation of any type of structuring solution, including company, foundation, and transformations, setup of funds, securitizations, issuing of notes and AMCs and their listings, as well as ongoing daily administration through our 45 office locations across the globe, 7 regulated asset management licenses, 14 licensed fund administrators, and our licensed bank. Thank you for your attention. I would be very happy to address any questions at the end of these presentations. Thank you.
Hi, hello everyone. My name is Alex. I'm the founder and managing director at Enhancement Solutions, an Amsterdam-based transfer pricing advisory firm. I've been doing transfer pricing for the last 15 years across several European countries. And I'm happy to be here together with my colleagues talking about this exciting topic in the context of international tax structuring. As you see on the screen, it's been 10 years since the famous BEPS project got concluded. As you know, the BEPS was a very ambitious and very successful project by the OECD and G20 to upgrade international tax system. Today we're talking about pre-BEPS and post-BEPS as two different tax worlds. We have this kind of Wild West world of the before BEPS, and we have the modern tax system of after BEPS. When the final BEPS papers got published in October 2015, I was based in Brussels at PwC, and we saw a huge spike in transfer pricing work. It was driven mainly by the documentation requirements, because one of the Action 13, introduced the new documentation standard. So everyone across the OECD countries, which include most of the developed worlds, the whole European Union and the US, and everything that we call collective West. So everyone started preparing documentation. However, the actual novelty of the rules was not in the documentation, but in the underlying concept behind it. Now, looking back 10 years, what we can see that in the last 10 years, what happened? At first, when the rules were introduced, countries gradually started introducing those rules in their local legislation. Then, after a couple of years, tax authorities started reviewing those years. Then, a few years later, we started seeing first court cases appearing that would talk about the actual application of the new rules in practice. Now, maybe every 2 or 3 weeks, there is an interesting new court case popping up, talking about transfer pricing in this kind of post-BEPS environment from one of those countries. And it's quite exciting for me to read those cases because I can learn about them. I'm quite enthusiastic about TP. I can imagine for you as in-house tax people, that's kind of scary and annoying and frustrating to see those cases because A, you see that there is a lot of controversy, and B, you see there is a lot of scrutiny, all right, by tax authorities. So you really need to be up to speed with those rules and with their interpretation, which is very important. So for today's session, we're going to talk about 2 key items behind the rules, within the rules, that are critical for international tax structuring. We will also go through a couple of examples where we can look at the numbers and how they change depending on changes made in the structure. So let's go into it. And the 2 concepts I wanted to talk about are the value creation and the control over risk. And let me explain what I mean by value creation. So Historically, the transfer pricing was about pricing an intercompany transaction. So if one entity within the group sells something to another entity within the group, the pricing of that transaction is to be the same as if they were independent parties. So how to do the TP analysis? The idea was, okay, let's go and find some uncontrolled transaction between third parties that have similar terms, and then use that as a comparable for pricing our transaction. Now, the value creation concept means that within multinational group, allocation of profit needs to reflect the relative value creation by each of the entities of the group. So you still need to price each and every individual transaction, but the outcome of that exercise needs to correspond to how value is created within the group. And this concept is very closely linked to another one, which is control of the risk. So if you say on paper that this entity does this and the other entity does something else, it doesn't mean that you just take that for granted and you follow the legal agreement. Now, you need to look at where the people who control relevant risks are physically located and in which location they actually perform their activities. And those two aspects change the way we do transfer pricing and make it much more complex. Take DEMPE concept, for example. Many of you will have used this concept in practice. That is relatively new, and for example, Germany only incorporated the DEMPE concept in their transfer pricing legislation starting from 2023, so only 2 years ago, although it was already in the original BEPS papers, of course. So what is DEMPE? DEMPE is development, enhancement, maintenance, protection, and exploitation of intellectual property asset. So if you're building a brand, someone must be busy developing and enhancing the brand. And someone should be busy protecting the brand so that no one else in the world can use it, right? Infringe the rights to your brand. If we talk about technology, someone needs to develop software, for example. Someone needs to do the maintenance, and then someone needs to sell it. So all those activities can be linked to the IP. What is sometimes misunderstood in the DEMPE concept, the idea is that, okay, DEMPE are clearly important functions. You need to know who performs DEMPE for an IP, which is not an easy thing to do, but okay, if you have IP, you have DEMPE. What is missed sometimes is that we're not just talking about DEMPE themselves, but we need to talk about control over DEMPE. So it's not an engineer who writes the software who necessarily creates lots of value from the perspective of IP. It's the management who takes decisions to allocate budgets to certain priorities. It's the management who decides on roadmaps. It's the management who takes the decision to hire 10 engineers in a country. So this is where a lot of confusion actually is. I hear a lot from clients say, yeah, I have those engineers in Germany, 50 people, and then tax authorities come in and say, oh, we have all the DEMPE functions here in Germany. We're going to tax your IP here at a high tax rate in Germany. Whilst in reality, control over DEMPE is not there. It's in a different jurisdiction. That's kind of an important nuance to remember. It's not just DEMPE, it's control over DEMPE we're talking about. Now, let's take a look at an example, or actually at a few examples. And we'll start with the financing example. So if a financial company on the left side, and then you have a trading company on the right side. A financial company lends money to the operational company, and OpCo pays interest back on the loan. And it's intercompany loan. You see there is an icon with a person on the slide. And so that person in the shirt and tie represents a treasury function in this example. So it's like people who actually control risk related to cash management within the group and who take decisions how to invest money and how to attract money. So see the little P&L of the FinCo shown on the screen. The loan is for 100 million. Interest rate is for 10%. Actual interest received by FinCo per year is 10 million, while the cost of funding is only 3 million. Meaning that FinCo is able to make 7 million in profit. The interest in this example is determined using CAP method. So in the market, third parties with similar credit rating as OpCos, say BBB minus, are able to attract loans of similar types, similar duration, similar currency, at a rate of 7-10%. And so if third parties are able to attract and lend at that rate, so surely Finco can also lend money to opcos at the same rate. So this is how transfer pricing works, right? However, if the facts are a little bit different and Finco doesn't actually employ any treasury people who perform control of the risk in this example, and say they are employed by an opco or multiple opcos, employ different treasury people, then the calculation change completely. So if Finco has no people, no functions to control risk, then it should not receive a full interest on the loan is provided, although we provided the loan under the same terms and conditions as before. In this case, you would use a different TP method to price this transaction. You would look at the risk-free return at the Finco level. And the interest rate in this example could be as low as 4%, representing a risk-free return compared to an adjusted return under the previous example. So you see the profit dropped from 7 million to 1 million, creating a completely different outcome because of the different location of a function, even though the legal setup hasn't changed at all. Now let's take a look at another example, which is a similar example, but this time with IP, some intellectual property. Think of it as a brand or technology patent or something like that, software. And again, we have like IP co, some people who are responsible for the control of redemption in relation to that IP that they own. It also has legal ownership over the title on the IP, and it licenses it to OPCO in return for a royalty. The royalty is set as 10% of sales of OPCO and results in 10 million royalty income for the IP co. And as IP co own costs are only 3 million, it makes a profit of 7. The license fee, similar as in our first loan example, is determined by reference to the third-party license agreements or similar IPs licensed at between 7 and 10%. So again, it makes sense to price this transaction at 10%. However, if IP co doesn't have enough substance, and by substance I mean control of the risk, then it should only be getting a so-called routine return, a risk-free markup on costs incurred. And so its profit goes down dramatically from around 7 million in previous example to 300K in this new example, right? Again, you see two very different extreme outcomes because different TP methods are used and informed by different location of important functions within the group. Now, those were theoretical examples, right? The real life is much more complex. 90% of cases, maybe 99% of cases, functionality is split among multiple entities of the group. It's not black or white. It's never black or white. Either different people sitting in different entities control different aspects of the risk, or they have shared control over the same risks. One way or another, you typically get in a situation where judgment is required to determine actually who is controlling the risk and to which extent. And this is where many transfer pricing people, my colleagues, myself included, we would say, well, what's the answer to that question? What should be the TP method? And we would say, it depends. Because it depends on the facts, it depends on how you, on your interpretation of those facts and, you know, how strong your arguments are. So this is where the art of transfer pricing becomes important rather than science of transfer pricing, because this is all about the narrative and the amount of facts and that you can use to support a position or to undermine a position. And this is where tax authorities can be opportunistic as well in some cases, because of course, when tax authority comes with an audit, they are there to get some tax. And if they see that there is an entity and maybe it has, as in my previous example, German entity, it has some engineers working on developing a software, and maybe another company in the group uses the software to make a lot of profit, then German tax authorities could would have, they would be kind of smart for them if they want to collect more tax to claim that, well, there must be some control over them in Germany. The engineers are there, certainly some of them are more senior than others. Some decisions are made in Germany. There must be some control over risk in Germany. So we want to see more profit in Germany because of that. All right, as a tax manager, you could say, no, actually it's not the case because I have all those other arguments why it's not the case. And this is where TP documentation becomes important, because TP documentation is not just your compliance document you need to have to check the box and to be compliant. TP documentation is your opportunity to control the narrative by presenting the facts in the way that supports your position rather than undermines your position. And once you have that documented in TP documentation by reference to objective facts and very well supported with evidence, it becomes almost impossible for tax authorities to play this game and to argue differently, because your analysis is already there and they cannot just ignore it. Now, it's also possible to use the rules and the way they work to your advantage, and you should do this. For example, when it comes to exit tax, what happens sometimes, and I've seen these cases, we have companies that have legal ownership over IP, but they may not have substance, or they may have never had any substance in terms of actual people taking decisions. It just, I don't know, an entity owns the brand, right? The name, the trade name. But it never had any marketing people. It never had any business people determining how much they want to spend on marketing, and the entity itself has never incurred any marketing spend because it was all done by the OpCos. But nevertheless, the entity has on the balance sheet certain IP value in relation to that trade name, for example. And in this example, it's say 1 million book value of IP, but market value can be 100 million. But because the market value of the brand is 100 million, it doesn't mean that this entire value should be allocated to that company that has legal ownership over this IP. So in this case, you could argue that whilst the market value of IP is 100 million, 99 million should actually be the OpCos who employ the controllable risk functions, and only 1 million, which is the book value, which corresponding to the legal ownership part of the IP, should be the IP co. So when you determine your exit tax considerations, and say you move this entity from Cyprus to Kazakhstan or to Dubai, having done your TP work could go a long way to help you deal with exit tax and to minimize this amount. Now, I think that's the last slide of my presentation with some key takeaways. And the takeaway number one is that the new rules are not new anymore. They've been around for more than 10 years now. Tax authorities know how to use them, and they do use them. A lot of very strong tax teams out there looking into your facts, asking the right questions, knowing what they want to achieve. So you also need to step up and be prepared for that. Your superpower as an in-house tax team is how you collect facts and how you can do the interpretation of those facts and documentation in your transfer pricing files. Because that's the starting point. If your transfer pricing documentation is good, it's almost impossible for tax authorities to challenge your position. We see a lot of court cases talking about shift in burden of proof, where as a taxpayer you prepare your documentation, and maybe some things are subjective and have arguments in both ways. Having prepared documentation which is compliant makes this discussion a non-starter from the court perspective, who says that, well, you've done the documentation, the burden of proof is on tax authorities to prove you wrong, which is almost impossible, right? Because it's much more difficult to prove someone wrong than not right, if you see what I mean. Well, finally, embrace those concepts and use them to your advantage where it makes sense, like with that liquidation example I just showed. And if you want to discuss this further, if you have questions, you can also reach out to me after the webcast. I'm based in Amsterdam, so if you are here, you want to have a coffee, drop me a text. I'll be very, very happy to connect. Thank you.
Okay, thank you. And I'm back again, and we are continuing with the third part of our webinar, which is about 3 stages of restructuring. And so far, we looked at 4 main principles and looked at some practical aspects of restructuring, including transfer pricing matters, as well as implementation techniques in specifically and solutions in Cyprus. Now let's move on and look at the 3 main stages of tax planning of restructuring projects. And those stages are, first of all, it's necessary to determine and select the target structure. Next, it's necessary to plan the transition to the target structure and consider different options of moving to the target structure and implementing it. And finally, there is the implementation stage where all the plans come into reality. And those are the 3 main restructuring stages that we work on with our clients. The target structure is the important stage where we decide what to do, what to implement, where to go. And again, here, let's look at a practical example and a case study where we will together design the target structure for a group of companies in the IT industry. And you can now see on the slides the simplified structure containing several companies, which altogether represents let's say a typical but simplified structure of an IT company in software development industry. Okay, so here we see shareholders that through the holding company own various operating companies, including the management company that employs personnel and provides strategic management oversight and strategic management of the business overall, the IP and R&D company, and the distribution company. And let's look at each of these companies, each of these functional entities in more detail. First of all, the R&D and IP company, its main purpose is to develop software, to employ software engineers, to pay to subcontractors, and to develop software which will be then marketed to the clients, so the company's clients, customers. And this IP company owns exclusive rights to the software that it develops. Okay, so this is the heart of the structure where the most important asset of this IT group of companies is located. Next is the distributor that finds clients, develops business relations, and concludes contracts with clients and receives revenue from the software that the IP company, IP and R&D company develops. Next is the management company, where all the management is employed and where some back office functions are performed, as well as strategic and operational management and oversights of the group as a whole. Next is the holding company, which again owns all the operating subsidiaries and in turn belongs to the shareholders. It basically receives dividends and holds its subsidiaries. Those are the functions. And finally, the ultimate shareholders, individuals who receive dividends, and one of the shareholders, let's assume, is the CEO of the group, which is not uncommon. Okay, so what transactions take place between the entities in the group? First of all, for the distributor to be able to commercialize the software developed by the R&D and IP company, they should have a license agreement so that the exclusive rights to the software are licensed. The exclusive rights are granted license to the distributor, which is then able to receive revenue from the group's customers. So this is the one part of the structure. Next, the management company, it's obviously should be financed, and it's very common to have management or advisory services agreements in place between the management company and other operating entities. In our structure, the R&D company, R&D and IP company, as well as a distributor. And after the whole group generates profits, which is in one way or another is allocated between the three operating companies. These three operating companies distribute dividends, which is the important cash flow in the group. And yeah, obviously these dividends are then distributed to the shareholders or invested into other parts of the business, I mean new ventures, etc. Let's look at the substance. These days, tax planning is highly influenced by substance, and it's no wonder. You already saw, we discussed, Alex explains why substance is so important and why transfer pricing is highly dependent on the allocation of people functions between functional entities in the groups. This is why let's look at the top management of the structure of this group. And first of all, Chief Technical Officer, who leads the software development team. He's based in Cyprus, but he's open to relocation to the United Arab Emirates. We will mention countries here because we will need to, at the end of the day, when we develop the target structure, where we already decided on the functional entities in the group, we will have to decide which countries they should be located in. And this is the main purpose of developing the target structure. Different parts of the structure can be located in different countries. This is why, given that substance is so important, let's look at the top management team and where they can work, basically where they can be located. So the Chief Technical Officer is based in Cyprus. He can relocate to the United Arab Emirates. Next, the CFO. She is based in the United Arab Emirates and is not very flexible in terms of location. So she's based in the United Arab Emirates. Chief Commercial Officer. He's based in the Netherlands, but he can move to Cyprus. And finally, the shareholders, they spend at least 3 months a year in Cyprus, but they are flexible in terms of relocation. And remember, one of them is the CEO of the group. This is important, where we decide to put him and to see how substance is created in one country or another. Other pieces of the picture includes currently existing Cypriot holding companies that belong to the shareholders, and there are some operated entities in the United Arab Emirates. And also the business plans to expand into Europe and establish presence in the Netherlands. So we can see here that there is a number of countries mentioned, namely Cyprus, the United Arab Emirates, and the Netherlands, which should be taken into account. And basically, those are the countries which we will look at when developing the target structure. Okay, let's summarize what we have in terms of the top management locations. CTO, Chief Technical Officer. His location will determine the country of the IP and R&D company. This could be either Cyprus, which is preferable. This is where currently the CTO is based, or the United Arab Emirates, where he is open to relocate to. Next is the CFO, and her location will determine where the management company is going to be established. And remember, this is the United Arab Emirates only. The distributor will be where the Chief Commercial Officer lives, and this is the Netherlands, basically, or Cyprus, where he can relocate it. The owners of the group, the shareholders, they also determine where the management company is located, but they're open to relocation. So basically, they do not limit the frames of our target structure tax planning. And they also determine where the holding company is located, and there are already holding companies in Cyprus. Okay, so choosing the jurisdictions for the group companies. This is the slides where we collected all the information about potential countries and options for structuring of the target group. is presented. The holding company can be either in Cyprus or elsewhere. The management company can only be in the United Arab Emirates because the CFO is based there. The IP and R&D company can be either in Cyprus, this is where the Chief Technical Officer is located, or it can be in the United Arab Emirates where the CTO can relocate. And finally, the distributor, the base case scenario is the Netherlands, and the alternative is Cyprus. Let's now look how this is this works in terms of numbers, because again, the group as a whole generates profits, but the way they are distributed between different entities, basically this is a transfer pricing exercise, which is highly driven by the location of management and the functions that people have in different parts of the group. And here, let's assume, and this should be backed up by transfer pricing studies and thorough analysis of transfer pricing methods and internal transfer pricing mechanisms of allocating profits between different entities. So let's assume that based on these transfer pricing considerations, the management company itself generates $2 million of profits. The IP and R&D company, this is the profit center, the main profit center, and it generates half of the total group's income, which is $5 million. And finally, the distributor generates the residual $3 million, and the total profits of the group are $10 million US. Okay, so given all this information, let's now look at the tax model, which we will I will present so that you can see how we arrive to the final calculations. Let's now look at the Excel table, which I hope you can now see, because here the first step in the Excel file is where we collect all information about corporate tax rates in each of the countries involved in the tax planning of the target structure. Here you can see the base tax rate, which is in the UAE is 9%, in Cyprus is 12.5%, and in the Netherlands is 25.8%. Next, there are IP regimes, IP box or similar regimes in some of these countries, basically in all three of these countries, where in the United Arab Emirates, it's possible to achieve the exemption for profits, for certain qualifying profits, assuming that all is done correctly, which we'll not go into at this webinar. But believe me, it is possible to achieve the 0% corporate income tax rates if a company develops and sells software in the United Arab Emirates. In Cyprus, there is IP box regime, which has its own conditions, but the achievable rate is 2.5%, which is just 20% of the general rate. And in the Netherlands, there is an innovation box, and the achievable rate is 9%. Again, let's not go into detail, but let's remember, if we put the IP company, the R&D company and the IP company, which is the same entity, in one of these countries, in the United Arab Emirates, it's going to pay no corporate income tax, and in Cyprus, it's going to pay just 2.5%. And finally, if the management company is located in one of these countries, then in the United Arab Emirates, again, despite the general corporate income tax rates, it is possible to achieve the exemption, the 0% rates on management, on profits, on headquarters services. This is what it's called in the UAE, which allows to apply the exemption, essentially, the 0% income tax rates to profits from management of related or providing services to related parties. In Cyprus and in the Netherlands, the general rates apply. Okay, so this table is important as the set of assumptions confirmed by proper analysis about the tax rates applicable in each of the three countries, depending on the type of activities that are performed in these countries. Okay, so here we have already pre-populated table, but let's remove the selected countries for the time being. And what we have here is again, this table is assumptions, allocation of profits. We already discussed that certain amounts of profits are allocated to different functions, different entities in the group. We're not going to change this. What we can change, and we are going to select different countries for the management company, for the IP company, and for the distributor. And let's look one by one at each of these companies and see how the table with the effective tax rate calculation fills in depending on our choices. So the management company, as you remember, only the United Arab Emirates can be selected here. It's not flexible. It's only the United Arab Emirates. And we already see that the rates is used from the table for the management company. It's 0 for the United Arab Emirates, which gives us no corporate income tax for the management company's profits. Next, we have a choice between Cyprus and the United Arab Emirates for the IP company. And let's choose Cyprus because this is the base case scenario. Remember, the chief technical officer, he is based in Cyprus, so this is the preferred option. And finally, the distributor, again, we have a choice here. The chief commercial officer can either stay in the Netherlands or go to Cyprus. If we choose the Netherlands, then the table is filled in completely, and the effective tax rates for the level of the operating companies is 9%. Okay, so this is helpful to to see the numbers and the ultimate results of the effective tax rates at the operating companies level. What we can do, we can change the UAE, we can't change. Cyprus can be changed to the United Arab Emirates for the IP company, and the United Arab Emirates, although it requires change of the location of the chief technical officer, but it improves the effective tax rates. And the distributor, again, it can be moved to Cyprus, and this is the lowest tax rates we basically can achieve. So remember, the base case scenario was 9%. The most efficient scenario is 3.8%. But this is not the whole story. What needs to be taken into account, and this is the next matrix, is where how dividends are going to be taxed when they are distributed by the operating companies. And remember, each operating company generates certain parts of the total profits. This is why we need to look at each country where the respective company is located and look at the taxation of dividends which are distributed up the chain to the shareholders. And again, we see here the source country, the United Arab Emirates, and again, it may vary, the withholding tax rates may vary depending on the location of the holding company. It depends on double tax treaties and sometimes on domestic exemptions. But for the United Arab Emirates, it's 0 for all holding companies' locations. So if the holding company is in the UAE, in Cyprus, or in the Netherlands, the result stays the same. It's 0% withholding tax rates. This is simply because there is no currently withholding tax in the United Arab Emirates. In Cyprus, it's very similar, no withholding tax here. In the Netherlands, on the other hand, the domestic rate is 15%. And let's assume for the time being that this is the rate that's going to apply. And the final row is the withholding tax based on domestic rates in each of the holding companies' jurisdiction. Again, we already saw that in the UAE it's 0, in Cyprus as well 0, and in the Netherlands 15%. Okay, so this table is pretty straightforward, but we can see that depending on the location of the profits, the source of profits, if they're in the Netherlands, there is going to be some withholding tax, at least based on the domestic rules. We'll go into some more detail later on. So this is the improved or more developed calculation where we not only take into account the operating companies level. Here we have the same table, but also the distribution of profits up the holding chain. And we will, let's again select the United Arab Emirates, Cyprus, and the Netherlands. And we can see again here that the effective tax rates at the operating companies level is 9%. And for now, for the holding company, we have a choice, and basically we can choose the United Arab Emirates, Cyprus, or the Netherlands. Let's choose Cyprus, for example. This is the base case scenario, and let's assume that it is not possible to reduce the withholding tax rates when paying dividends from the Netherlands to Cyprus, and it is represented here by 15%, which is the domestic rate in the Netherlands, and the total effective tax rate is 12.3%. Okay, but if we for just imagine that substance at the holding company's level is proper, and in the Netherlands it is possible to reduce withholding tax for dividends to 0 if the structure is right and it is not considered to be abusive. A substance a big part of this requirements, in which case dividends can go through the holding structure without tax leakages at all. But the challenge here is to make sure that there is substance at the holding company's level. How to achieve it is a different story. But let's change the again the selection of countries, and let's try to achieve the most tax efficient structure. For that purpose, we will need to choose the UAE for the IP company and Cyprus for the distributor. And here we see that the effective tax rates, again, we already saw 3.8% at the operating company's level. And for the holding structure, again, it can be Cyprus. We don't care about substance because there is no withholding tax at Cyprus. And the ultimate rate is 3.8%. It's easy to notice here that to make the structure, to implement the structure, we'll need to relocate some top managers in the structure. The chief commercial officer needs to be moved to Cyprus, and the chief technical officer needs to go to the United Arab Emirates. Okay, but this is another possibility. So we already saw the so-called the is structure, where nothing changes, and basically we set up companies where the top management is located, and the structure where we achieve the least tax burden and the most tax efficient structure, but this requires some changes in the location of the top management of the group. And okay, one more exercise. Let's not move the IP company from Cyprus and leave the distributor in the Netherlands. And let's imagine that the IP company is now combined with the holding company, which will mean that the holding company will have proper substance. And well, given the rules that apply in the Netherlands, it is possible to achieve if the structure is right, if the structure is set up properly, including proper substance at the holding company's level, to achieve withholding tax exemption in the Netherlands. And we see that there is no tax leakage on the distribution of dividends from the Netherlands, and the distributor stays in the Netherlands, generates profits there. They are taxed at a comparatively high tax rates, but we do not have to relocate the chief commercial officer, and the effective tax rate is 9%. Okay, so those are our options. Let's go back to the slides now. Let me translate the presentation once again. Okay, so let's summarize what we've just seen. There is this structure where nothing is changed, and the companies are set up exactly where the top managers are located. We have the effective tax rates of 12.3%, 3 different jurisdictions, excessive withholding tax on the distributor's profits, but no need to relocate anyone. The most efficient tax rate, option 2, is where we achieve the effective tax rates of 3.8%. The structure is much simpler because there are just 2 countries involved. We do not have the Netherlands, but it's most, so to say, relocation intensive option. We will need to move to top management from their preferred countries to other places. And finally, option 3, which is a compromise between the tax efficiency and the status quo, so to say, when managers are located where they prefer to live. We achieve the effective tax rate of 9%, but the structure is simple because, as you can see, we do not have a separate IP company here. It's combined with the holding company. Both are in Cyprus, and this gives us an advantage of having substance at the holding company's level and leveraging from the withholding tax exemption in the Netherlands as a result. So the effective tax rate is higher, comparatively higher, but the structure is simpler and there is no need to relocate anyone. And this is the final comparison. We have all 3 options here. As you can see, this option is least tax efficient. We have option 2 with the lowest effective tax rates, and option 3 with in between with the moderate tax rates. Different complexity of the structures, 3 different countries in options 1 and 3, just 2 countries in option 2, which is, by the way, again, the most tax efficient, but option 2 requires change in location of top management, which is not ideal, as you can imagine. And let's remember that there was an intention to move to the Netherlands and to expand a business of the company, of the group, to Europe, which will mean that option 3, which already contains the distributor located in the Netherlands, is best aligns with the strategic plan, strategic development priorities of the group. And to me, option 3 sounds like a good choice, despite a relatively high tax rate. It's not the lowest possible, but it's most strategically suitable to the objectives of the group, and it's more kind of natural because it doesn't require relocation of management, and people stay where they prefer to stay. Okay, 3 conclusions here. As you can see, planning around tax planning these days is planning to a large extent around substance, where people mostly are located. Solutions need to be found at the intersection of the tax efficiency and achieving business objectives. It's not always feasible to chase the lowest effective tax rates. Sometimes it's possible to sacrifice the tax efficiency for some other benefits, non-tax business benefits. And finally, tax modeling helps to consolidate multiple options and to compare them in a single picture, with the effective tax rate being the most important tax factor, but also other factors need to be taken into account when planning the target structure and selecting it. We just have a few minutes left to discuss stages 2 and 3, transition, planning, and implementation. Again, probably those are big topics for another time, for a different event. But briefly, restructuring plan, key considerations. It's helpful to review several options to achieve the target structure. Again, we looked at the target structure only and developed what is preferable. But then, given that there is current structure, the restructuring needs to take into account different steps, and different ways to achieve the target structure should be considered and compared in terms of their tax efficiency as well as business feasibility. Solutions need to take into account timing, efficiency, practical aspects, and the 4 tax objectives that we discussed in the first part. Tax leakages should be minimal. Tax assets and tax efficiency of the structure should be preserved. Ideally, the structure can be improved, its tax efficiency, and some additional assets, if possible, can be considered to be created. And implementation, the final stage when all the plans come true, and the restructuring plan is rarely implemented without in its original form, without changes in course of the restructuring. And during implementation, what we help our clients to do is to take into account new developments, changes in tax law, and also unforeseen factors. It is never possible to foresee all the obstacles and limitations when planning the transition. And upon the implementation stage, we help our clients to take those into account and to adapt their selected restructuring plan to the new environments and to implement the structure as is necessary. Okay, so this is it. The third part is over, and we still have time to answer your questions. So stay tuned. I will get back together with other speakers to answer your questions. Yes, thank you. Hello again, and I hope that we are back online and we are all three again. Let me propose to check once again that you can hear and see us. So please type in the chat, in the chat something like a plus or another symbol, because I hope that everything is working and we can now turn to answering your questions. But let's wait for the confirmation that everything is fine. Yeah. The translation goes with a bit of delay, so you can only see. Yeah, I think we have some confirmations that you can see and hear us. Okay, so as promised at the end of the webinar, we are addressing your questions. And let me propose to start from the questions that we received before the event. In the registration form, there was a possibility to describe your situation or ask a question. And the first question from Sneha, I think I hope that I pronounced the name correctly. And it looks like it's about transfer pricing. So I'll read it out and ask Alex to comment. In many industries, transfer pricing structures are increasingly similar. Is this convergence happening because business models are becoming more streamlined, or is it due to the way regulations are evolving? So Alex, could you tell us?
Yeah, sure. So where do I start? To start maybe in 80s and 90s, with the advance of technology and communication, it became possible for the first time to run international business remotely. To say you have headquarters in New York and you were able to run your European business remotely. And this gave rise to those centralized models where multinationals were able to centralize a lot of their operation, leverage scale. Instead of every factory having procurement team, now you have one single procurement team sitting centrally. And getting higher discounts from suppliers and for raw materials and stuff like that. And of course, transfer pricing reflected that. So we saw the rise of centralized models, and centralized models are by definition similar to each other, right? While the decentralized models tend to be all different and unique. So now, since maybe 2020, we see the trend going the other direction. Actually, less centralized model than before, more nuanced models. And of course, every model is tailored to business, so it's unique. So I would say since COVID 2020, deglobalization is a global trend started, right? But also in transfer pricing, because of the DEMPE and other rules, we see those models become more nuanced.
Yes, yeah. Okay, thank you, Alex. Let's move on. And the next question, again, we received it before the webinar. Rajat is asking how Pillar 2 is affecting corporate tax in the United Arab Emirates. Well, this is a complex topic, and yeah, we had a whole webinar on this topic a couple of weeks ago. But yes, there are Pillar 2 rules, in particular domestic minimum top-up tax, introduced in the United Arab Emirates starting this year, 2025. And indeed, it does affect structures. International companies with revenues exceeding 750 million euros on a consolidated level. So if you have an international structure, which means that there is at least one company in the group that is outside the United Arab Emirates, then the consolidated revenue, it may be even a domestic group with the ultimate parent entity in the United Arab Emirates, but it still is subject to the domestic top-up tax. And if you have such a structure, then your local tax obligations on a combined level, on an aggregated level of all entities in the United Arab Emirates is going to be increased from to up to 15%, according to the rules of calculating the tax base. And you have to arrive to the effective tax rate of 15% based on the specific Pillar 2 rules. This is basically it. So there are no other parts of Pillar 2 reform introduced in the United Arab Emirates yet. So there is no income inclusion rule, which is good news. Income inclusion rule are similar to control foreign company rule. They are not introduced in the United Arab Emirates yet. But if you have a multinational company working in the UAE and paying less than 15% effective tax based on specific calculations, then most likely you will need to top up the local tax using the specific calculations prescribed by the specific regulations which were adopted last year, in December last year in the United Arab Emirates. They are quite lengthy and the process is complex. But it is what it is. You are right. Pillar 2 rules indeed affect structures in the United Arab Emirates. As long as the structure is international and the consolidated revenue exceeds 750 million euros. Okay. I think we also have a few questions asked by the participants during the webinar. Let me read those out. The first one was about transfer pricing asked by Olga. You responded to it, Alex. You responded to it during the webinar. Would you like me to read it out and tell us your answer once again, or what?
I'll just add a couple of words to what I said. That the majority of transfer pricing cases get resolved not via courts, because actually courts and judges working in courts, they hate transfer pricing cases. Every time you go to court with a transfer pricing case, it's a gamble, because the judges don't like it, they don't understand it. Like judges in the Netherlands, although OECD guidelines directly refer to in the Dutch decree as a kind of source of truth for transfer pricing methodology, judges disagree with that. They say, how come, some OECD organization that has nothing to do with Dutch democracy and our democratic institutions has something to say about how to, apply Dutch rules. So judges don't like the OECD. They don't like OECD guidance. They don't like transfer pricing. They don't understand it. And so that's why you don't want to go to court case on transfer pricing matters. You want to get it resolved differently. And how you get it resolved? You get it resolved either proactively via an APA, or you resolve it via a MAP. So you get the corresponding adjustment on the other side. And of course, in those discussions, you get two tax authorities who do like OECD guidelines, because they know it's the only basis they can use, that they can come to an agreement on. So there you see all those complex discussions around control of the risk between tax authorities, or between taxpayer and tax authorities. And there you see how detailed they are, how they look at those reporting lines and authorization limits, and we see more of those complex questions coming from tax authorities. So this is where I say, well, you cannot avoid it. You don't read about it in the court case, but you can read it in questionnaires you receive from tax authorities, and as a part of those discussions.
Yes, thank you, Alex. Let's move on. We have a few more questions in the chat. Zain, again, I hope that I'm pronouncing the name correctly, is asking, for a multinational enterprise with consolidated revenues exceeding 750 million euros, does utilizing an IP box regime in jurisdictions like Dubai or Cyprus to achieve the effective tax rate below 15% trigger Pillar 2 top-up tax? And specifically, will this tax be collected by the ultimate parent entity via the income inclusion rule or by the source jurisdiction via a qualified domestic minimum top-up tax, effectively neutralizing the IP box benefits? Well, this is exactly to the point. This is another topic which we couldn't cover during this presentation, but you are right. The tax reform, the Pillar 2 rules, they do not allow. They are aimed to prevent companies to pay less than 15% effective tax rates. And you are right. If we are talking about a structure where there is a multinational enterprise that is subject to the Pillar 2 rules, then it seems likely that any IP box benefits are going to be neutralized either by the domestic top-up tax, such as might be the case in the United Arab Emirates, or by the income inclusion rule, which will tax the residual between the 15% rates and the actual effective tax rates at the level of the ultimate parent entity. So you are right. This is another part of the equation which needs to be taken into account, and effectively, it doesn't allow it. Well, makes no sense to use the IP box regimes in structures where Pillar 2 rules neutralize the IP box benefits. And in Cyprus, both in Cyprus and in the United Arab Emirates, domestic top-up tax rules are already in place. Elia, if you would like to comment, I propose that you.
I think you have covered it. I think you share more knowledge on the Pillar 2 aspects of things and how that would affect the local regime as well. I think
in Cyprus, they were introduced even earlier. The domestic, as far as I remember, DMTT rules are already in place, and they were introduced in 2024, which means that locally unpaid tax is going to be topped up, and the effective tax rate of 15% should apply on a local level in Cyprus for multinational companies using the IP box regime. Okay, let me scroll down and look if we have other questions.
Victor, if I may just very short comments about the Dutch IP box regime, right? So Dutch tax authorities are of course aware of Pillar 2 and the 15% rate. So when they do grant rulings for IP box regime, they try to make sure that the blended tax rate you get to pay overall in the Netherlands will not be below 15%. So even those big companies like ASML is the biggest company in Europe, they have IP box regime in the Netherlands. So they don't get effective tax rate of below 15%, even though they do those machines to produce, chips of the latest generation. So super high tech company, but even they, have 15%.
In the Netherlands, it is obviously different than in Cyprus because the headline rate is more than 25%. And this is connected to one of the next questions that we have here. Again, Zayn is asking, the first 20,000 euros as opposed of profits is taxed at 19% in the Netherlands. Yes, this is a response to one of the earlier questions. Yes, again, if it's a comment to my tax model, then obviously the model is simplified. It's assumed that there is a flat rate in the Netherlands of 25.8%. But you are right. To small profits, the rate is a little bit lower, which we usually ignore in large scale calculations for simplicity purposes. I think this seems to be it in terms of questions. So unless Alex and Elia, you have anything else to add to what we discussed during the 2-hour period, I think it's time to call it a day. So what do you think? Is there anything else to add, or maybe you received individual questions? Then feel free to answer those as well.
From my end, thank you for this opportunity. Happy to address any specific questions of our participants in relation to Cyprus for that matter. So our contact details are there. Anyone can reach out to us for further analysis.
Well, similar from my side. Many thanks for the opportunity, Victor, Elia, and our participants. If you have questions, you want to have a chat about transfer pricing, you're in Amsterdam, eager to have a coffee, please reach out. I'll be very happy to connect.
Yes, I totally agree. And I'm never tired of saying that each situation is complex and each situation is unique. And what we do with our team at Global Aim and other speakers here is we help companies in their specific circumstances and advise on the best way to move forward. And restructuring projects are very difficult to plan and implement. And this is what we do on a day-to-day basis. And we'll be glad to continue our discussion. So feel free to reach out. Our contact details will be on our last slide. And it was a pleasure to be with you over the last 2 hours. Thank you for your time, and let's keep in touch.
Thank you.